All right, let's get right into it. Today, we're going to peek under the hood of a big company to see if it's really built to last. And forget all that confusing Wall Street jargon. We're going to use a simple but really powerful checklist, inspired by one of the best investors of all time. This is the big question, isn't it? I mean, you can stare at stock charts and these dense financial reports until your eyes glaze over. It feels like trying to read a whole different language. So, how do you actually cut through all that noise and figure out if a company is truly solid? Well, for that, we're going to borrow the playbook from one of the most successful investors ever. See, the Warren Buffett way isn't about fancy algorithms or trying to time the market. Nope. It's all about thinking like a business owner and just looking for a few key things that make a company genuinely great. And the company we're going to put through this checklist today is US Bancorp. They're a huge player in the banking world. Now look, we're not here to tell you to buy or sell anything. We're just using this company as a real-world example to see how this simple, powerful framework actually works. Okay, first things first. This is maybe the most important question on the whole checklist. Does this business actually make money? And not just for one quarter, but consistently, year after year. A company can have a great story, but for a long-term investor, profits are what really matter. So, one of the best tools to measure this is something called return on equity, or ROE. Just think of it like this. For every single dollar that shareholders have invested in the company, how much actual profit is the management team able to squeeze out of it? It's a fantastic measure of just how efficient a business really is. And for US Bancorp right now, that number is sitting at 11.30%. Now, why does that matter? Well, a lot of savvy long-term investors, including Buffett, tend to look for companies that can consistently generate an ROE of over 10%. So right off the bat, this is a very solid start. But, and this is important, consistency is absolutely key here. One good year doesn't mean a whole lot. What we see is that the current ROE of 11.3% isn't just a strong number on its own, it's actually higher than both its 3- and 5-year averages. That signals real stability. It tells you this isn't just some one-off good year. This is a company that performs well over time. Now, having a profitable company is awesome, but we also have to check the risk. Buffett famously steers clear of companies that need huge piles of debt just to operate. So the debt-to-equity ratio gives us a really clear picture of this. It basically asks how much of the company is funded by borrowed money versus how much is funded by the owners themselves. US Bancorp's current ratio is 1.20, and what's really interesting here is the trend. Not only is this a totally manageable level of debt, but it's actually lower than its average over the last 3 years. This shows they're managing their finances carefully, which is exactly the kind of prudence you want to see. Okay, so the business is profitable and it manages its debt well. That's a huge checkmark. So for our next question, we need to ask, is the company actually getting bigger? And maybe more importantly, is it sharing that success with the people who own it, the shareholders? And this chart really tells a story. What you're seeing is the company's average revenue growth rate. Over the last 3 years, it's been growing at almost 12% per year. And over 5 years, it's even higher. This isn't just a little bit of growth. This is strong, consistent, double-digit growth. That's impressive. Buffett has talked a lot about the power of just owning wonderful companies that take care of their shareholders. And one of the most direct ways a mature, healthy company can do that is by paying out dividends, literally handing you a piece of the profits. And this number, wow, this number speaks volumes. For 14 years straight, US Bancorp has increased its dividend payment. Think about that. Through all the ups and downs of the economy, for 14 years, they have raised that payment. That shows an incredible commitment to shareholders and a ton of confidence from management about the future. All right, so we've pretty much established that we're looking at a profitable, growing, shareholder-friendly company. But here comes the final, and maybe the most crucial hurdle. As Buffett loves to say, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The big question is, are we overpaying? The P/E ratio is a classic tool for this. It basically tells us how much investors are willing to pay for every dollar of the company's profit. Right now, it's sitting at 11.92, which is almost exactly in line with its average over the last 3 years. This suggests the stock isn't trading at some crazy, overhyped price compared to its recent history. It seems reasonable. And this brings us to the absolute cornerstone of Buffett's entire philosophy, the margin of safety. It's such a simple but powerful idea. First, you figure out what you think the business is actually worth, its real intrinsic value. And then you insist on buying it for way less than that. It's like finding a way to buy a dollar for 50 cents. That discount is your protection, your cushion in case you're wrong. So, what does that margin of safety look like for US Bancorp? Well, based on one common valuation model that uses free cash flow, the actual cash the business generates, it looks like there's a potential margin of safety of nearly 39%. That is a huge discount between the current stock price and what this calculation says the company might be worth. So, let's pull all of this together. Let's lay it all out on a final scorecard. We've gone through our whole checklist, we've looked at profitability, we've looked at growth, we've looked at the price. So, what did we find? The pros are pretty obvious, right? We saw that strong profitability with an ROE over 11%. We saw stable debt management, that incredible dividend history, and that solid double-digit growth. And on top of it all, a potential 38% margin of safety. But no company is perfect, and it's really important to see that over the last 5 years, the company's earnings per share have actually gone down a little bit. That's a really important piece of the puzzle you have to consider. And there you have it, a quick Buffett-style checkup on US Bancorp. Now, the goal here wasn't to give you a buy or sell signal. It was to give you a way of thinking, a framework. When you look at profitability, growth, and price, you can start to see the story that a company's numbers are trying to tell you. So, based on everything we just saw, what story does it tell you?